These days we hear a lot about the government and economics, so let's talk about monetary policy. Monetary policy. Monetary policy is when the government changes the interest rates. It's when the government, well, when the central banks change the interest rates. So we could say that the government or the central banks have lowered interest rates. Therefore, they have a easy monetary policy. If they put interest rates up, like if interest rates are 10%, that would say they have like a tight credit policy. It's either easy or tight, or loose and tight. So loose credit or easy credit is low interest rates, and tight credit is high interest rates. So, what is the second type of policy? Well, it's fiscal policy. If I can get this paper undone. Okay, there. Fiscal policy. Fiscal policy. Fiscal policy is how much how much money does the government spend to try to like build roads, build schools, have hospitals. That's fiscal policy. So we hear a lot about fiscal stimulus. Well, the so-called stimulus is part of fiscal policy. And again, they can have a loose fiscal policy where they just spend like crazy, or they have a tight fiscal policy where they save money and try to have a surplus. So, what is productivity? This is a measure called productivity. Productivity. Productivity means how much stuff do we make for how many hours we work. So if we're building a lot of stuff and we don't work very much, we have high productivity. But if we work all the time, every day working, and we're not building much, we're building very little, then that would be a low productivity. And the way the government calculates productivity is GDP divided by number of hours worked. So they're saying like the total economy divided by how many hours that we worked. Well, that's the government, and because the government likes to put fake numbers out and overestimate GDP, underestimate inflation, they make the productivity numbers like go up every year, even though it's really actually going down.